Welcome to our channel, where we unlock paths to wealth and success. Let's grow rich together. Friends, have you ever wondered why some people got rich overnight with Bitcoin, while many others ended up losing all their savings? In today's video, we're going to talk about Bitcoin, a concept that sounds cool and tempting. We'll start by explaining what Bitcoin actually is, uncover the risks lurking behind it, and discuss why it might not be the best choice for ordinary people to strike it rich anymore. Stick around till the end for all the insights you need. To put it simply, Bitcoin is a type of digital currency. Imagine paying for a cup of coffee using your phone, but instead of money being deducted from your bank account, it comes directly from your digital wallet. There's no bank involved. Sounds convenient, right? Bitcoin was created in 2009 by someone or a group using the pseudonym Satoshi Nakamoto. It aimed to establish a revolutionary decentralized monetary system. To this day, no one knows who Nakamoto really is. Some speculate he's a cryptography expert, while others think it could be a team backed by a nation. This mystery only adds to Bitcoin's allure. In simple terms, decentralization means that instead of relying on a government or bank, users can conduct transactions directly through a transparent network. It's like using cash with a friend, no middleman, but in digital form. The core technology behind Bitcoin is blockchain, which acts like a public ledger. Every transaction is recorded and almost impossible to tamper with. Unlike traditional banking systems, where records are stored in central servers, blockchain's ledger is maintained by miners across the globe. Take banks, for example. A centralized system where they dictate your account balance and approve transactions. In contrast, no single entity oversees your money in the Bitcoin ecosystem. Miners perform complex calculations to secure transactions and earn Bitcoin as a reward. This decentralized design makes Bitcoin transactions reliable and free from the interference or control of any single entity. It's the first ever completely decentralized digital currency, drawing attention from countless users and investors. Initially, Bitcoin flew under the radar. A single coin was worth mere pennies. Over time, its price skyrocketed. As of January 2025, Bitcoin is priced at around $27,000, a far cry from its early days but still below its all-time high of $60,000 in 2021. However, don't let these numbers fool you. The risks behind them are just as astonishing. Think of Bitcoin like gold. You need specialized computers to mine it. These mining machines are not only expensive, but also energy-intensive. This means Bitcoin comes with both technical and cost barriers, making it less accessible to the average person. We all know that U.S. policies significantly influence the global economy. Particularly in finance, Bitcoin's decentralized nature challenges traditional systems. So, what stance might the Trump administration take on Bitcoin? The U.S. government's attitude towards Bitcoin has always walked a fine line between skepticism and recognition. During Trump's presidency, he publicly expressed doubts about Bitcoin and other cryptocurrencies, citing concerns over their use in illegal activities like money laundering and terrorism financing. However, more recently, Trump's tone seems to have shifted. In a 2024 interview, he referred to Bitcoin as a wealth preservation tool and acknowledged its potential value in today's economic climate. This statement has been interpreted as tentative support for cryptocurrencies, reflecting his distrust of traditional financial systems. However, it doesn't mean regulations will be loosened. In fact, the U.S. government continues to enforce strict monitoring of transactions and tax compliance to stabilize the market. This nuanced stance highlights Bitcoin's dual role as both an innovation and a regulatory challenge. On the other hand, Bitcoin has driven technological and financial innovation, such as advancing blockchain technology for decentralized applications. But its very nature of bypassing traditional financial regulations also raises red flags for governments. As a result, many adopt a publicly supportive but cautiously restrictive approach, allowing Bitcoin trading while imposing strict anti-money laundering and tax laws. Some countries even ban specific cryptocurrency activities outright. This balancing act reflects the ongoing struggle to manage both innovation and risk. When it comes to risks, you might wonder, could Bitcoin crash suddenly? The answer is absolutely. Firstly, Bitcoin's price is extremely volatile. It's not uncommon for it to swing 20% in a single day. This wild fluctuation stems from the relatively small market size and the significant impact of investor sentiment on its price. This volatility isn't limited to Bitcoin. Other cryptocurrencies face the same risks. With the lack of robust regulation like in traditional financial markets, some cryptocurrencies, altcoins, can skyrocket or plummet in short periods. Technical flaws, team failures, or shifts in market sentiment can render them worthless overnight. This makes the entire cryptocurrency market highly unpredictable and challenging for regular investors. Secondly, Bitcoin lacks any physical backing. Unlike company stocks tied to real-world businesses or gold with intrinsic value, Bitcoin's worth depends entirely on market confidence. Even gold, which has limited practical utility, derives its value from widespread recognition. Bitcoin hasn't achieved such universal acceptance, making its global circulation inconsistent. While some countries ban Bitcoin trading outright, others embrace it. This inconsistency weakens its stability and increases its susceptibility to price swings. Additionally, Bitcoin's usability is limited. While it's theoretically a payment tool, you can't use Bitcoin to buy most goods or services. Its poor liquidity means its value is tied more to speculation than practical application. If market confidence falters, Bitcoin's price can collapse, compounding its already high-risk nature. Another factor worth noting is how Bitcoin ownership hinges entirely on private keys. Whoever holds your key holds your Bitcoin. Losing your key means losing your Bitcoin forever, with no way to recover it. This design, while enhancing privacy and security, poses a significant management risk for everyday users. Furthermore, Bitcoin mining is concentrated in a few regions like China, the US, and Kazakhstan. This geographic concentration makes the network vulnerable. A major power outage or internet disruption in these key areas could severely impact Bitcoin's efficiency, potentially bringing the network to a halt. Such an event could trigger market panic, leading to a massive sell-off and a price collapse. Finally, while Bitcoin is considered secure, its trading platforms are not always reliable. Hackers have infiltrated several exchanges in the past, stealing investor funds. These losses are almost impossible to recover, underscoring the need for extreme caution in the Bitcoin market. In summary, Bitcoin was once a field full of opportunities, but now it's more of a high-risk, high-barrier investment. While many wealthy individuals own Bitcoin, they mainly see it as a wealth preservation tool rather than a way to build their fortunes. For regular people without sufficient expertise or risk tolerance, surviving in this market is incredibly tough. Instead of risking everything on Bitcoin, consider more stable investment options. Building wealth takes time and patience, and chasing overnight riches often leads to overnight poverty. Friends, if you still have questions about Bitcoin, feel free to leave a comment.